Good morning, everybody. Happy Monday. It is college football kickoff week. There were some games over the weekend, but week 0, but this is officially week 1. So if you're a college football fan, we hope you will get to watch some games starting Thursday night this week. Listen, we're excited to have some of our great partners on WealthVest, which, as you may or not know, they use the H.O.P.E product. We're thrilled. And Matt Heyman, who's one of our great products here, he's the national sales manager of WealthVest, has actually brought some great people on here to share some great information. So, Matt, I'm going to turn it over to you.
All right. Well, hey, thanks, Mayo. Thanks very much. Grateful to be hosting the webinar for StoneX this morning, and we're going to get to our keynote presenter here momentarily. But I'll just share that we're particularly excited to be hosting today because we're also announcing the national rollout of the Aspida suite of annuity solutions at StoneX. We had a small pilot rolling that we started in February with just 5 advisors. Those 5 advisors have already submitted about $11 million since February, and so we're looking at replicating that success across the organization. For those of you that are not aware, Aspida Life is a leading digital-first insurance carrier backed by Ares Management, who is also a leading global asset manager with 546 billion in AUM with a market cap in excess of 50 billion. Really an outstanding partnership. And so effective today, we're announcing the launch of the suite of MYGA products, which is a 2-year, 3-year, 5-year, 7-year durations. To give you a taste, 5-year rates today with that 5-year MYGA with liquidity is 5.4%. And then also we have a leading accumulation FIA with our WealthLock accumulator that will be launching as well, 5, 7, and 10-year durations. Really, really deep allocation options for everyone on the call. The WealthLock accumulator last year was a Barron's Top 100 product, as ranked by the Index Standard and Salt Financial. The index options in there have 6 of the top 20 index options across the industry, including the number 1 1-year point-to-point option with the gold ETF and the number 1 equity only index with Bank of America. Also embedded in there, of course, S&P caps and pars, NASDAQ triggers. So really a comprehensive product. Next week, on the 2nd, when you come back in, you'll see the S&P cap is going to move to 11%. And also, this is the 5 years of product that you can write to age 90. All Aspida products will be supported by our sales team. We've got number 1 market share in 2 top leading broker dealers, and hope again to replicate that success and support all of you as you help clients plan into and through retirement. And you'll see more from us with our marketing and launch campaign. In the meantime, if you have questions, you want to get appointed, give us a call, 877-811-6081. Again, 877-811-6081. Myself and our team look forward to serving you and helping your clients plan. So with that, let's get on to today's presenter. And to introduce Mr. Parati, I'm going to invite Michael Ramos, who is National Accounts Leader, to do a formal introduction for Tim. Thanks very much.
Thanks, Matt. Michael Ramos here. Pleasure to be on your morning call. I have the easy job and wonderful pleasure of introducing my good friend and colleague, Tim Parati, who has over 25 years of experience in various aspects of the equities business. Prior to joining us here at WealthVest, Tim spent 7 years in equity research management roles at Deutsche Bank and most recently at BMO, where he was a managing director and head of U.S. product management. Tim has 11 years of investment experience, most notably as head of consumer research and portfolio manager at the Galleon Group, which is a former New York-based $8 billion long-short hedge fund. And Tim's also a graduate of Boston College, if we have any Boston College alums on our call, and currently resides in Summit, New Jersey. For those of you here that are on our call and those that are listening on the recording, Tim is actually a part of our partnership in a unique role where he can help really drive better business conversations and help you address client concerns at Chamber of Commerce events, Rotary clubs, and really client-facing seminars. It's one of our support for StoneX at no charge as part of our partnership offering that WealthVest can provide. So, Tim, thanks for being on. The floor is yours.
Yeah, thank you very much, Ramos. And yeah, I would just say, look, the best thing everybody is going to find out about Aspida is how good the customer service is and how good the technology is. The second best thing is that hopefully you can utilize me, right? I've been in the markets for really 30 years. I was a banker. I was a trader. I was an equity research guy. I've been a macro analyst on the buy side. So I don't necessarily have all the answers, but I think I have a pretty good understanding of how to frame the debate. Just one other thing by way of background, I am from Memphis, Tennessee, and as Mayo mentioned, we are starting college football season, so I couldn't be more excited about that. But instead of college football, let's take a minute and talk about the business cycle, right? Let's talk about the economy. Because I think we're at an interesting point in this economy where it's pretty hard to tell, are we early cycle or are we late cycle? You know, there's some aspects of this economy that feel very late cycle, right? Valuations are very, very high. Unemployment is starting to go high, right? That is quintessentially late cycle. But you still got a hell of a lot of fiscal support in this economy. And the fact is, there's plenty of arguments to make that where you could say, hey, we might be really early cycle here. Look, financial conditions are super loose. Banks want to lend, right? Credit spreads are super, super tight. And by the way, it's kind of hard to argue that we're super late cycle if the Fed is telling you, like Powell told you on Friday, the next move is very likely to be a cut, and we're in a global economy, right? And the whole global cycle feels early cycle, right? What are central banks doing all around the world? They're cutting interest rates. So from that perspective, hell, despite the move that we've had in these markets, despite valuations bumping up around all-time highs, it's not a slam dunk to say that we're early cycle, this is a bubble, it's going to be over soon. The fact is, you just simply don't know that. What I like to do, what I use, and I think it's educational for everybody on this call, is I use a framework called H.O.P.E, right? It's an acronym for housing, orders, what does demand look like in the economy, consumer and manufacturing. Mostly I'm talking about consumer because we're a consumer and a services-driven economy. P is for profits. H.O.P.E, P is for profits. It's when profits inflect, good or bad, that companies either make the decision to hire or start laying off. So E is employment. So I find it really useful to walk through those components. Housing leads, right? There's a famous economist named Ed Leamer who famously said in 2007, housing is the business cycle, right? So if you get housing right as the leader in the business cycle, you're going to get the rest of the economy right. Now, housing sure as hell looks late cycle, right? Inventory is certainly moving up. Completed unsold homes are making the highest levels since 2009. Existing inventory, which has been incredibly tight, as everybody knows, because people like me, I'm an empty nester. I've been in my house for 20 years. It's a bigger house than I need. I'm in a high tax town in Summit, New Jersey, but I got a 2 7/8 mortgage. You can't live anywhere cheaper than where I already am. But even with that being the case, existing supply is starting to move up. And as you get into areas where there is housing deflation, Atlanta's got some weakness. Tampa, a lot of Florida's got some weakness. Austin, Nashville, parts of California. But the weakest markets are really Texas and Florida. When you get deflation, you tend to get more supply because somebody like me goes, oh man, I don't want to miss the top. I didn't think my house was going to be worth with this much. I don't want to miss the top. So that tends to bring out more supply. But when people think about a housing downturn, what do they think about? They think about the most recent housing downturn, which was 2008, which was obviously a disaster. I don't see anything like 2008 coming to pass today. First of all, people have much more equity in their houses. You don't have hundreds of thousands of people buying houses completely on speculation. You have the generational wealth transfer, which is leading to the fact that, according to Ivy Zellman, who's an outstanding housing analyst out of Cleveland, Ohio, her work shows that about a third of all home buyers, not just first-time home buyers, but a third of all home buyers are getting family assistance. Well, as the baby boomers are on average 70 years old, that is only promised to accelerate. We have more of that family support for people buying houses. So to me, I just don't see housing falling apart. What happened in 2008 was housing hit a wall and rolled. So there was no new supply, there was no new construction. And the result of that was you had a ton of slack in construction-oriented employment. And that's where so much of the unemployment, which ripped higher in 2009, came from. I don't really see that happening this time around. One, the fact is that like 40 to 50% of the people that are building homes are immigrants, illegal and legal. And with so many illegal immigrants being taken out of the country, that certainly takes slack away from a downturn in the housing market. And the other part of it is the aftermarket, the refurb market. Labor is so incredibly tight. Everybody on this call knows what it's like to try to find an electrician, a plumber, an HVAC guy. You know, I wrote an essay recently about just how tight the trades are. So even in a weaker new construction environment, I don't see an environment where there is a huge slack in unemployment, a huge rise in unemployment, so a big slack in construction workers. So I just don't see the housing market having the impact that it had in 08. Is housing a drag? Sure it is. Is it going to continue to be a drag? Of course it is. But again, in 2008, you lost a lot of equity in your house, right? If you speculated and bought a house for $1 million, you could be sitting on that thing down 20, 30%. Housing has had such an incredible move since the pandemic. Prices are up so much that if I'm down 5%, if I'm down 10% from the highs, is that going to change my activity meaningfully? Is that going to create what's economists call a balance sheet recession, which is what you're seeing in China, right? Housing prices are falling, so everybody saves. Nobody wants to spend any money because they feel themselves getting poorer every day. I don't think that you have a dynamic that happens like that in the US around housing. So look, housing is a negative for the business cycle. And just to avoid burying the lead on this whole presentation, housing is going to come down to the 10-year. Housing is going to come down to long-term inflation expectations. And what I think was so bullish, not to get on too much of a digression here, what was so bullish about Friday was not just the fact that Chairman Powell was dovish, but he was dovish and there wasn't much of a curve steepening. In other words, the long end of the yield curve held in pretty well. You're still stuck here around 55, 56 basis points of differential in 2s, 10s. So to me, housing is a drag. Everybody knows it's a drag, but is that what is going to cause the economy to fall into a recession? Doesn't feel that way to me. And look at the XHB. The XHB is the ETF where you find Home Depot, Toll Brothers, all the big, Mohawk Carpets, all the big housing entities. And that's had a pretty big move. You've had like a 20% move up. You're starting to see existing inventory absorption start to move up. The guys who cover the multifamily REITs, I spent so much time on Wall Street, I happen to know all the REIT analysts and so forth. Those guys are getting more bullish because they see the multifamily stuff, absorption starting to go up, and rent, you've had this big drag on CPI and PCE around shelter. The experts in housing are seeing that start to maybe bottom out, where new rents at around 0 through the Sun Belt, they think are going to start to tick up, and existing rents, which never went negative and rarely do, will continue to accelerate again. So again, that kind of covers housing, where I just don't see a disaster. I see a continued drag, but look, it's going to come down to the 10-year. If the 10-year goes to 7, housing's going to roll hard. And my guess is you would have a recession, right? If we lose fiscal credibility, if we lose monetary credibility, and we can talk about all this, I'm going to run through all this stuff in about 5 or 10 more minutes, and then I hope we can have some questions and talk about these observations. But if the 10-year gets away from you, you're going to have a recession. Housing's going to be really weak. But let's just say the economy continues to kind of soften, weaken a little bit. Powell's right. You're not reaccelerating. The bigger risk is unemployment. And the 10-year goes to 4, and you get a little bit of spread compression on mortgage rates, and you get a mortgage rate at around 6. I would think housing absorption really accelerates. The housing market does well there, and you would see the XHB, the equity components within housing, start to go higher. On the consumer front, is the consumer getting weaker? There's some signs of it, right? I mean, real income growth is slower. The difference between wage growth and the inflation rate keeps getting lower and lower. But look at Johnson Redbook retail sales, 5.5%. It looks like restaurants are slowing a little bit. It looks like hotel traffic is slowing a bit. The airlines are telling you that there's a little bit of weakness on the consumer side, especially international. But is it falling off a cliff? Not really. I don't see really any signs of that. So and I feel like for 3 years I've been writing the consumer's slowing just a little bit. And that's been right, but man, the little bit is the most important part of that. So is there some inflection that is coming where consumer spending is about to fall off a cliff? Well, I didn't hear that from Walmart, Home Depot, Lowe's. Hell, Costco is going to comp, it would seem, 5% a quarter every year for the rest of our lives. So you don't see this immediate fall off on the consumer. The manufacturing part is going to be difficult just to assess, because you had so much pull forward that you're definitely seeing some manufacturing weakness right now, but you're going to have to give that a few more months. So let's look at the profit cycle. What did Q2 earnings look like? Q2 earnings look pretty damn good. Now, the breadth isn't that great, right? The profitability growth is really dominated in tech, finance, the banks with a little bit more of net interest income, a little bit of a wider spread with the curve steepening a little bit. Banks are doing pretty well, and their credit quality is really good, which again, you would expect to see credit quality deteriorating if we were super late cycle. That is not happening. Maybe student loan resumption will create an impact, but if you listen to Visa, you listen to MasterCard, you listen to some of the entities that manage the credit for the retailers, you're not seeing credit defaults 90 days decelerate. Are they high? Yes, but what matters when we're talking about the economy or markets is rate of change, and rate of change is not getting worse. So that's the profit side. Profits look pretty solid. Actually, earnings estimates have actually been pushed up for Q3. So when I hear Chairman Powell say, look, the big risk is that employment goes lower, what's the catalyst for that? The unemployment rate has basically been flat for a couple of years now. Continuing claims have been getting a little bit weaker for 3 years, but initial claims are like a dead person on an electrocardiogram. I mean, it's like initial claims are at 235. They are unchanged. We're in this kind of very slow period where firings are maybe ticking up just a tiny bit, not much. It's definitely harder to find a job. It's definitely harder to find a job if you're in a white collar field, if you're a recent college grad, if you're somebody my age, 50 years and older, those jobs are hard to get. But man, there is no slack across service industries, and there sure as hell is no slack across trade and skilled worker industries. Every month, the NFIB will come out and say, look, 40% of companies can't find labor, can't fill open roles. So the profit cycle to me is still pretty strong, and so is the employment cycle. So what does that all mean? It means that we're in a slow economy. I don't see a catalyst to what makes us fall off into a recession unless the 10-year gets away from us. And that gets into this very important concept of inflation. And let me just take 1 minute to talk about inflation, because we do, I think, have a differentiated view around inflation. We have a view that there is real global structural inflation. For my whole career, inflation's been falling. For my whole career on trading desks or wherever, if you were the dude worried about talking about inflation, people were like, man, you're a perma bear. Go worry somebody else about that. Nobody cares about inflation. Inflation's dead. And that was right for literally a couple decades. Well, that period is over. We now have an extended period, in my opinion, of higher inflation and higher inflation volatility. Look, if we do have a recession for whatever reason, inflation is going to go lower. You destroy demand, you will destroy inflation cyclically. But the secular pressures on inflation aren't going away. And those are aging demographics. That is real tightness in the labor force because of those 70-year-old baby boomers who are leaving the country, and far, far less immigration into the country and actually emigration occurring. And then it's also the fact that we have had a free trade world that has meant, you know, the old David Ricardo comparative advantage. If Vietnam can make that t-shirt cheaper than anybody else, then hell, buy it from Vietnam. That drives inflation lower. That drives profitability higher. That's good for the economy. We've gone from kind of a concept of ideal production to redundant in our own production. And that, to me, is long-term secularly inflationary, and I think that continues. Powell and the Fed, however, are looking at inflation, and they're saying we should look through tariff-driven inflation because it's only a one-time price reset. I think that's optimistic. We don't know. We simply don't know. There's no precedent for the kind of tariff policy that we have now, excluding Smoot-Hawley, which is not a good precedent. It's almost 100 years ago in a very, very different world, a very different global economy. So the introduction of protectionism after decades of free trade, I think that's a meaningful long-term threat. And even if the Fed does want to look through tariff-driven inflation, take a look at what happened on the last ISM non-manufacturing, where you can start to see real pressure in prices for services. That's being driven by labor, in my opinion, right? We have a weaker labor market, but there's enough of the labor market in enough industries that are still too tight. And in those industries, there is still wage pressure higher. And then the last piece is, are we losing fiscal and monetary credibility, right? The president has threatened to fire Powell. He has threatened to indict another member of the Fed. And I do think that comes with risks. The benefit is we may get lower interest rates. But and it didn't happen on Friday, but if there starts to become a fear that, look, we've got no fiscal credibility running 7-8% deficits, and now we're maybe losing monetary credibility, if that turns into a long end of the curve getting away from us, then I think we could have problems. You would have problems in housing, and then I think you would have a recession. Let me just say one last thing. Long end yields are going higher globally. French long-term yields just made a new high. JGBs in Japan keep making new long-term highs. Germany, UK, all over the world, there is a recognition that the long period of secular disinflation is over, and we may be in a more inflationary world. So look, just to wrap it up, cyclically, as I went through with that housing, orders, profits, employment, my hair's not on fire, right? It doesn't feel to me like we're about to slip into a recession. You have incredible fiscal accommodation. Is that fiscal accommodation going down or going up? It's a little hard to measure, but it's not dire. But my more negative view is more the view that there is secular pressure on inflation. So let me cut it there and turn it back to you, Mayo.
Thanks, Tim. I appreciate that. That's intriguing. One thing we did do this call, we don't have live Q&A, which is good and bad sometimes. But interesting you say that. It's just let me ask you this question, Tim. Where would you put money the next 6 to 12 months based on interest rates and what Powell may do, but then turn that to when Powell does retire, I put in quotes, we could have a very different model, very different market at that point in time with interest rates, especially if it comes in with someone who's more on Trump's mentality of where rates should go.
Yeah, I think it is such a cop out, but I do think it kind of depends on your time frame. Look, one thing I always say is that valuation doesn't do a very good job at predicting what your returns are going to look like over the next 6 months or for the next year. But over a 5-year, 7-year, and 10-year, it does do a pretty good job of predicting your returns. So if you as a fiduciary are trying to put together a portfolio for somebody that's going to be a long-term asset allocation, I think you got to be pretty careful as to how aggressive you are in large cap tech in the S&P. Look, I do think that, I unfortunately, when I first started in this business was, I started in the business in 1995. Back then, everybody was reading Benjamin Graham and was a valuation person. People thought valuation was super important. And I tend to still believe long-term valuation matters. So I think mid caps and small caps from that perspective as a little heavier than what you would have otherwise been allocated. And look, for young people, just, belong in this market, right? But that's not what we're talking about. All the money is people 60 and 65 years old. So I do think that allocations to international make more sense. You've had just such a valuation disparity and such a lag, mid caps and small caps. And look, I do like gold. I do like, and even Bitcoin. If you believe that you're in a secularly inflationary world, and the only answer to that really governmentally is to continue to print more money, then I don't see how you wouldn't love gold and Bitcoin, which is by definition a finite asset in a world of infinite fiat money.
Right. Okay. Thank you. And just a note for all our listeners out there, including people listening to the recording, you cannot solicit Bitcoin to your clients, just FYI. But I think your point's great.
Yeah.
I think your point's great. Listen, Tim, do me a favor, if you will, real quickly. Will you share your contact info, or how can they get in touch with you if they'd like to have you come speak to maybe a client dinner, lunch, like you said, Rotary, Chamber of Commerce, any type of event? That's phenomenal. You're willing to do that. We appreciate that. So if you'll share that info.
Yeah, I'll be doing one of those events in Denver this week. But yeah, I am on the road. I want to be on the road. And my email is tperotti, TPIEROTTI @wealthvest.com. Feel free to reach out to me, and we will work with Ramos and Mr. Heyman here on putting something together. Look, when we do these Chamber of Commerce events, we can really help advisors bring in, who do you want to be around? If you're an advisor, you want to be around all the guys who own small businesses in your town. So those chamber events end up being home runs for guys looking to get closer to the money in their community.
I agree. Listen, Tizzy just shared, we're going to send your email out as well when we send the recording out to the entire field. So that's great. So Matt, Michael, Tim, we really appreciate you guys stepping in today and doing this. A great presentation. We're right at 28 after, which is perfect. We got all this content in 28 minutes, which is phenomenal. So Matt, from the WealthVest side, we look forward to the rollout nationally. We will work closely with you guys to make sure everybody gets at least an understanding of how the products work and the benefits of them. Otherwise, everybody, I hope you have a great week. Enjoy the first week officially of college football. It is kicked off. I guess we officially kicked off in Ireland, which was a good game. And but look, enjoy your games this week and this weekend, and we'll see you soon. Thanks. Have a great day and great week, everybody. Bye.